$9 billion in net negative index hedging accompanied Monday's slow decline. The SPX closed at 7,745, down 0.52%, while VIX rose 6.45% to 15.18. The important question is not simply why stocks fell. It is why the pressure stayed orderly instead of becoming a broad liquidation. The Nasdaq 100 declined only 0.17% as semiconductor strength offset software weakness. VIX finished at 15.18, and volatility reached 93.92. The index covered 59 basis points from high to low after same-day options had priced only 29. Puts traded over calls at a ratio of 1.52. The macro sequence started with crude above $90 after a Middle East escalation report. Inflation expectations firmed. The 10-year yield rose 3 basis points to 4.72%. And equities and treasuries fell together. That combination is consistent with an inflation-driven pullback, not the usual growth scare pattern. Other markets kept the message contained. The dollar was nearly flat. Gold was also nearly flat. Bitcoin gained more than 2%. Inside the Nasdaq, chip shares advanced, while software weakened. Together, those readings suggest an oil and rates repricing, rather than a general rush away from risk. The positioning data sharpened that interpretation. Index hedging finished negative $9 billion. $5 billion came from longer-dated call selling, and $4 billion from same-day put buying. Equity-level flow was negative $1.3 billion, much smaller than the index reading. That imbalance supports the view that index hedging amplified the decline, while individual stocks were not moving as one. The structural map is more useful than a synthetic intraday chart. Price closed at 7,745 after losing the 7,775 pivot and the 7,765 volatility inflection. First support sits at 7,727, followed by 7,706. The deeper character change level is 7,682. Positive gamma remains active above that point, so movement can still be dampened, even though the short-term posture weakened. Volatility delivered two conflicting messages. 1-month implied volatility was 11.27%, below realized volatility at 13.27. The annual implied volatility rank was only 5.94%, yet downside skew ranked at 96.05%. In plain terms, total movement remained inexpensive, while protections specifically below the market carried a substantial premium. One standout hedge reinforced that concern. About 146,000 September VIX 24 calls traded near 70 cents, representing roughly $11 million of premium. The position was established with VIX near 15. It does not predict an immediate volatility spike, but it shows meaningful demand for protection through September. The index system recorded 3 wins and 1 scratch. The successful signals included a resistance fade, a downside break, and a rebound from the lower acceptance area, adding roughly 9 E-mini points in total. The Nasdaq strategy recorded 1 same-day call loss. Every position was closed before the end of the session. For Tuesday, the base posture is cautiously lower while price remains below 7,775. A rebound into the 7,765 to 7,775 band becomes a decision area, not an automatic short. If the market loses 7,727 and accepts below it, 7,706 is next. A move towards 7,682 would signal a more important change in hedging behavior. The constructive branch starts with a reclaim of 7,775. Holding above that level shifts attention to 7,801. Then the prior high, near 7,818. Import prices at 8:30 are Tuesday's first meaningful test because energy inflation shaped Monday's move. Wednesday carries the heavier combination of volatility expiration, a 20-year bond auction, and central bank meeting minutes. The conclusion is straightforward. Monday weakens the short-term posture without breaking the deeper structure. Save the level map and follow AlgoIndex for the next market close decision update.